They know what they're doing. In this episode, I'm going to address the question, how can indexed universal life insurance companies afford to pay 11%, 15%, 25%? How can they do that? You're going to be blown away when you learn they're big boys and girls, they know what they're doing, and they can do that. So my name's Doug Andrew, and I've been using Universal Life since it came out, the brainchild of E.F. Hutton, in 1980. When indexed Universal Life first was introduced in 1997, I was all over it. And my clients, since that time period, increased their average rate of return on their Universal Life from 8.2% up to over 10% by using indexed Universal Life. You wouldn't believe how many financial advisors and even insurance agents do not understand indexing and how an insurance company can afford to pay 10%, 15%, even 25% and more. So I'm about to share with you something that's actually a secret. You wouldn't believe how many advisors that people think know it all, and I can stump them in less than 60 seconds by asking them a few questions, and they go, huh? Well, I've heard about that, but how can they do that? Okay. Now, when you have an indexed universal life insurance policy, it means that your money inside that insurance policy is being invested in their general account portfolio. See, an insurance company, where do they put their money? That's your money, actually, when you put it in there. See, banks and credit unions, they put 30 to 40% of their Tier 1 assets into insurance companies for liquidity, safety, for predictable rates of return. They borrow our money at 1% and they make 5%. That's 5 times. On every million that we deposit into the bank, they pay us 1% or 10 grand, and they put it in an insurance company and they earn 50 grand. Now, you can do that. Just bypass the middleman with long-term goals, your serious cash. So this is why E.F. Hutton came out with this brainchild back in 1980. And they said, why don't you just bypass the middleman? You can put your money straight into an insurance company or companies and earn their general account portfolio rate. But back in 1980, clear until the 90s, the interest rates on the insurance company's general account portfolio was 10, 15%. In fact, I never earned less than 11.75% from 1980 to 1990. I earned as high as 15.5%. Why? Because the insurance company, with their billions and even trillions of dollars, are investing in AAA, AA bonds, mortgages on shopping malls and skyscrapers, and very few into stocks, but they're very conservative. But see, back then, interest rates were high. Mortgage rates were clear up in the 18 to 20% range. And so they were paying high interest. Now later, after the turn of the century, we've been in this 20-year low of interest rates. And so insurance companies on bonds and on mortgages have only been earning maybe 4 or 5%, sometimes 6%, because the old mortgages are still on the books and so forth. So if an insurance company is now only earning 6%, you can sort of hunker down and just settle for that. Now they take about 1 of those percentage points for them, and then I net 5%. So for example, on every million I have in my IUL, if I just want to be very conservative, hunker down and play it safe, because I maybe think we're headed for a recession or something, or a market crash, I can just settle for 5% on my million. That's 50 grand. So far, so good. So I can do that, and actually 5% is pretty good when banks, we're only paying 1%. And this is where banks put their money to earn 5% after they borrowed it from us at 1%. Hello? You can do that, but when interest rates are low for borrowing, they're low for earning. When they're high for borrowing, they're high for earning. See, interest rates are relative. But if you want to participate in the market, sometimes people say, why would you ever want to be stuck at 5% when the market's booming at 10 or 15 or 20%? I know, well, you don't have to. You can link your returns to an index of your choice. Now, most of the companies where I put my money have several indices. It could be the S&P 500. It could be the Dow Jones. It could be the Russell 2000. It could be the Barclays U.S. Dynamic Balance Index. It could be the Euro Stock Index. See, and people say, well, which one do you use? all of them. I diversify the smart way among all of them. But see, when I link my returns, listen close. I am not putting my money in the insurance company at risk in the market. That's variable insurance. I've never owned a variable insurance policy, never will. My million, in this example, in the insurance policy is safely tucked in the insurance company. In this example, let's say earning 5. So they cannot put my $1 million out in the market if I say link to the market. Link means that I'm linking the return to an index of my choice. An index is like a measuring tape, okay? So let's measure the S&P 500, the Dow Jones, the Russell 2000. Let's measure from November 15th to November 15th of the next year. See, that's a 1-year point-to-point linking date. And so I measure the S&P. If the S&P in that year period, like back in 2011 when I did this during the Obama second-term election, because I was pretty sure the markets would be high. And sure enough, the market went up about 20%. So what I did is I linked. Now let's say I link to the S&P 500. What the insurance company does is they take the interest on my million. 5%, that's 50 grand. I relinquished the for sure 50,000. You don't have to keep that on hand as a guarantee for me because I'm going to go for it. Don't risk my million. Just take the interest on my million. What do they do with it? The insurance company simply buys upside options in the S&P 500 if that's the one I chose. These companies are the #1 purchaser of options in the world. They do it hourly. So what happens? If the S&P goes up 10%, 50,000 of options doubles to 100. They have the wherewithal to pay me 100,000, 10% on my money. If it triples, the 50,000 triples to 150,000. They can pay me 15% on my million. But they have to cap it because they only have the interest on my million. They don't have the full million to work with. So they cap me at 15% or 16%. So in 2011, I was capped at 16. And so even though the market went up 20, I was capped at 16, but I'm okay with that because what if the market would have taken a nosedive? What if there would have been a terrorist attack? If people lost 40% having their money in the market, instead of my million going down to 600,000, my million just stays at $1 million. I gave up the for sure 50,000. See, I earned 0, and sometimes 0 is your hero. But by using indexing, there are years like 2017 that many of our clients capped out at 16%. Others capped out at 25%. And of course, people say, how can they afford to do that when they're only earning 5%? And I go, now you wouldn't believe how many financial advisors ask me that question. If the insurance company on their general account portfolio is only earning 5, how can they afford to pay you 25? They're big boys and girls. They know what they're doing. They wouldn't pay it if they couldn't afford it because they took the interest on your money and they bought upside options. So they have the wherewithal to pay 25. So if you're getting it, I just explained how an insurance company only earning 5% on your money can afford to pay you 10, 16, even 25% because you allowed them to take the interest on that money and buy upside options to take advantage of the upside and eliminate the risk. If you guess wrong, you may not make anything, but you don't lose, but you make money when the market goes up. If this has given you some insights into opportunities that maybe you didn't know existed before, let me summarize the takeaways. When people ask, how can an insurance company afford to pay 10, 15, 25%, especially when they're only earning 5% on their investment portfolio? Hopefully you know the answer. It's because they know what they're doing. And if you sort of take the pressure off of them to make sure that you have 5% at the end of each year, if you say, you know what? I think the market is going to do better than 5%, so I'm willing to give up the for sure 5, let you take that interest on $1 million, that's 50 grand. Do whatever you need to do with that 50,000 so that if the market goes up, I get to benefit. But if the market goes down, I'm okay with giving up the for sure 50,000, but don't you dare put my $1 million at risk. I want to keep my principal I started out with. See, it was Will Rogers that said people get more concerned about the return of their money than the return on their money when things get bad. And so I love indexing because it allows me to participate with the upside potential, but also protect myself. If the market crashes, I don't lose. I may not make anything, but I don't lose. And historically, what does that mean? It means that I have earned on the average between 7 to 10% tax-free, which is double what people who have their money in the market actually end up earning, because most people buy and sell at the wrong times. Dalbar, who studies investor behavior, says the average stock market investor with money in like mutual funds, if they bought and just left it alone and held, might earn 9.14% average. But if you have to pay tax on that, sooner or later, you're not netting 9, you're netting 6. But most people, according to Dalbar, only earn 3.49. Why? Because when the market starts to go down, they panic and they finally sell after it's dropped 30 to 40%. And then when it starts coming back up again, they wait and they wait and they wait and they buy high. They sell low. And they buy high, and that's why the average is only 3.5%. That's why most financial firms only recommend you take out 4% a year, because if you're only earning 3.5% and you take out 4% of your nest egg, you will slowly deplete your nest egg, but probably not before your LE, your life expectancy. If you want to have as much as double or even triple, if you want to earn 8 and not deplete your nest egg, instead of taking 4% and then having to pay tax on the 4% you're pulling out, $1 million pulling out 40 grand, netting you only 30,000 after tax, maybe only 20,000 after the 1% fee they charge to manage that million? Or would you rather have 80,000 that predictably generates tax-free income without depleting principal? That's why I'm so passionate about this information. Other questions like this are on my YouTube channel. Feel free to subscribe and search different questions and get answers. But if you want to study this that I've been talking about, my most recent book, The Laser Fund, will explain this in depth. It's 300 pages of charts, graphs, explanations, 62 actual client stories. And I want to gift this to you free. And so I'll buy the book. You go to laserfund.com. I will gift it to you. You simply pay $5.95 shipping and handling. Get a copy of the book, get empowered, and begin to establish and create your brighter future, earning the rates of returns that you deserve.